Thanks, Tom. So we've got an ad rating 254 target price on Orora. So 5 key points on why we like it and why it's part of high conviction. Number one, it's defensive. So Orora generates around 60% of revenue from defensive sectors such as food and beverage. So I think in the volatile market environment, it should receive some good support. Number two, it holds strong market positions in both Australasia and North America. So in Australasia, it's either the number one or the number two play in its main markets of fibre and beverages. It's also quite a consolidated market in Australasia, also quite rational, with the other main player being Visy. In North America, Orora is the number 4 biggest packaging distribution provider over there, and over there it is a bit of a different market. It's actually a bit more segmented with a lot of smaller players. Number 3, so despite being defensive, Orora does have a lot of growth opportunities over the next few years, especially in North America. Given the fragmented nature of that market, there are a lot of potential M&A opportunities and small bolt-on acquisitions. However, despite the number of opportunities, Orora has over the last few years proven to be quite disciplined as well, and the acquisitions that they have made have been very good, so we're becoming increasingly confident that they will continue to acquire well. Number 4, the balance sheet is very strong. So on gearing, which is a net debt to EBITDA basis, it's at 1.7 times. That's well below management target of being less than 2.5 times. So they do have a lot of headroom to pursue those growth opportunities. They also generate a lot of free cash flow. So even if the gearing was to get towards that 2.5 times level, they do have the ability to pay down debt quickly if needed. And finally, it's trading on FY16 P of 17.5 times, 3.8% yield. It does sound a little bit expensive, but it's actually in line with the Industrials Ex-Financials Index. However, we think it deserves to trade at a premium given its defensive characteristics. It's got a very good management team. A lot of them are ex-Amcor, and it's also got a good growth outlook. So we've got an EPS CAGR over the next 2 years of 14%. So I'll move over to Dulux. So we initiated in Dulux yesterday with a hold rating and 6.18 target price. It's generally a very defensive and stable business. It's got very strong, well-known brands such as Dulux, Selleys, Yates, Cabot's and B&D Garage Doors. They all hold the number 1 position in their respective fields. If you look at Dulux, for example, they've got a market share in the mid-40%, so around 45% or so, and that's almost double the number 2 play, which is Wattle, at around 25%, and the number 3 player, which is Taubman's, at around 20%. So a very strong position there. It ticks all the boxes in terms of fundamentals, so it generates really good returns. So return on capital, 27%, return on equity, 35%. It's got a good balance sheet, generates a lot of free cash flow, and has a very experienced management team. So the CEO, Patrick Houlihan, he's been there for 26 years. Even if you drill down to the general managers of the individual business divisions, a lot of them have also been with Dulux for 15 to 20 years as well. So a lot of experience in that team. The other key point is that it has only a small exposure to the building market. So that's only around 15% of revenue. The majority of Dulux's revenue, around 65%, is generated from the renovations and maintenance sector, and that generally is a lot more stable over time. But trading around PE around 18.5 times, it's got a 3.8% yield, but we've only got EPS growth of on average of around 5% over the next couple of years. So I just think there's limited upside potential at these levels. Where would I buy it? I think it closed at 6.24 yesterday. I think if it was to fall closer to the 550, 570 level, I think it'll look a lot more interesting. So I'll leave it there.